which is why you're seeing the stock just correct a marginal bit, generally an illiquid stock. The parent company's word on a possible delisting would of course be the key street focus, but so far no word on that, and the results have been bang in line with street estimates. But let's shift focus then back to the mutual fund industry. S. Krishna Kumar, fund manager, Sundaram BNP Paribas Mutual Fund, now joins us. Mr. Kumar, firstly, congratulations on winning the award in the mid-cap and small-cap segment. Your outlook in terms of fund flows, we wanted to start with, because we've heard that August, September, October, November were slightly negative months in terms of redemption pressures. How have you seen your mid-cap oriented fund in terms of fund flows towards the latter half of last year? And have you seen some bit of a recovery in the preceding 2 months of this year?
Yeah, I think what's happened is that given the strong performance in the small and mid-cap end of the market, our funds like Smile and Midcap have been seeing a fair bit of inflows over the last 2-3 months. Smile especially over the last year, I think we have seen net new cash of more than 200 crores coming into the fund in the last 9 months. So I think broadly, if you look at as a fund house, I think we are marginally positive on net new cash coming in, and I think the situation seems to be improving at this point in time. Over the last 2 months, as you know, the markets have corrected a bit and valuations appear a bit more reasonable. That's drawing a lot of investors on the retail side who want to come in and invest for a 1 year to 2 year kind of horizon at this point in time.
Krishna Kumar, your sectoral distribution has been metals and financials heavy. I mean, they are your top 2 sectors in terms of preference. How will it be for the next 2 quarters? Would you veer away from financials? What would be your top sector picks?
I think given the kind of uncertainty that appears to cloud us at this point as far the global recovery is concerned, I think there has been a sharp run up in metal prices earlier, and which is giving way at this point in time, as there are some doubts in terms of the strength of the recovery. So we would be neutral to underweight on metals at this point in time. So that would not be definitely in the top few sectors that we own. As far as financials is concerned, I think though there could be differing views in terms of credit growth, in terms of NPLs, in terms of the the interest rates going up and that affecting banks. But I would we would like to play financials from more a demographic perspective. We think it's a big play on the Indian consumer and the Indian growth story. I think if we believe that we have to grow at about 8 to 9% over the next 3 to 4 years, I definitely see that there will be there will be a fair bit of credit growth in upwards of 18 to 20% per annum over the next few years. So this would definitely be a positive for the banks. And in addition to that, if you look at the banks which have a lot of income from fees, I think those would be the ones which would probably also enjoy a fair amount of higher profit earnings growth. And
you want to make a distinction between public sector and private sector banks? So where would your preference lie?
Yeah, as we think that the PSU banks which have return ratios like ROEs in excess of 16 to 18%, which are comparable now to the private sector peers, I think they appear to trade at a relatively cheaper valuation at anywhere between 1 to 1.3 times price to book. So I think our preference would be to be overweight on PSU banks. At the same time, given that there are few private banks which are definitely growing at a faster clip, we would selectively buy into private banks.
Krishna, I wanted your sense on the entire mid-cap setup, because usually this is where you get alpha from. These are where all the interesting multi-bagger stories emerge from. But there has to be a nice conducive setup in terms of liquidity, enough institutional interest for you to buy a chunk, for you to exit in a significant amount. Do you sense that with large caps having run up so much over the past 1 year, liquidity still being a flush in the system and the big boys consolidating now, all factors in the environment are conducive to mid-cap stories taking off?
Yeah, I think you said it all. The economic environment on the domestic front is fairly good, conducive. Growth seems to be back with the bang. I think there is fair amount of liquidity in the system. in spite of the government borrowing program, etc. And in terms of equity capital, there has been a fair bit of fundraising where mid-caps have capitalized themselves well for investing into new growth projects. So I think, looking into the next 2 to 3 years, I think this big outperformance of mid and small caps over large caps will continue. The environment looks good. I think interest rates would harden, but I think not too significantly to upset growth plans. So the domestic consumption story is playing out well.
Okay.
I think the mid caps have a great story.
Okay. Well, 2 questions related to the budget, Krishna. In the first place, before the railway budget, it's customary for all these small cap, mid cap stocks to run up, the rail related ones. Would you top up on any of them? And the other more important question is, how are you approaching the union budget at all? This seems to be a low expectation budget, so would you buy up before the budget? If so, what would you go long on?
I think as far as the railway budget is concerned, as you said, there are limited plays that are available. So, the existing portfolios would probably be positioned, in certain weights in those kind of stocks. As far as the union budget is concerned, I think, the expectation levels, as you said, are definitely low. People expect that there will be a small rollback of the fiscal stimulus. There will be probably, a fiscal deficit which would appear, it will be very reasonable under current circumstances, and which would be far better than what FY10 could turn out to be finally. So I think that we think that the government would shoot for a higher growth at 8.5% to 9%, and that would make a big difference to the entire revenue numbers, and hence the fiscal deficit as a percentage would look fairly decent. So I think we would be definitely positive in the run up to the budget, though we don't see markets really moving up significantly in the shorter term.
Sure. Krishna, final word then, just as a mid-cap manager in these volatile markets, have you sensed that your rate of churn or your flipping game may have to be slightly more quicker, and you need to be slightly more adept to the huge market environment? So at this point in time, is it just buy on dips and hold for a long period of time, or are newer themes getting caught on to extremely quickly and with equal ease getting disposed of in a couple of weeks? How do you approach the market in terms of ferocity and volatility as a mid-cap manager?
Yeah, I think in the last year, we definitely went through a phase when the valuations really caught up quite in a quick manner. So the kind of churning levels were pretty high last year. But I think getting into the current year, we would see that investors and fund managers will be more selective in terms of the stocks that they own, and the tenure of holding in the company would tend to be longer, and hence the churn could possibly be lower in CY10 than in CY09 for the mid-cap space. But having said that, it's definitely a dynamic market, and one has to take a call as we go forward.